right, traders, welcome to week five. Um, week five, we're going to be talking about risk management and accountability um, when trading. So, this is not going to be a long week, it'll be real short this week. Um, but risk management and accountability are so important in trading. It's probably one of the most important things. Um, all trading is risk management. It's, you know, whenever you can master sticking to your plan with a good thesis trade plan with risk management implied, that's the key to consistent profits. And we all know how important accountability is. We want to know what we're doing, how we're doing it, and we want to make sure we're doing, the best job we can as far as being efficient. So look at the quote, Michael Koval or Covell. Know what you're going to do when the market does what it is going to do. That's all that risk management is. Having a plan in place. All right. All right. Risk management is vital when trading the financial markets. The goal of this section is to be able to assess how much you're willing to lose on a single trade and when exactly you should exit a position. And this is both on the profit and the loss side. You should know exactly when you're going to exit, when you're taking profits or if you have to cut the loss. Choosing the risk management strategy is only half of the battle. Sticking to it is, the other half, the bigger half. Anybody can put, plan on paper or whatnot, but if you don't follow the plan, what's the point? You know, being able to stick to the plan you have, outlined will determine how good the trade is, not how much you make or lose. So I mentioned the importance of discipline all throughout this course, but risk management is where it matters the most. Definitely. The hardest thing to do is to cut your loss or close the trade when it's appropriate time to do so. And, you know, risk management tells you exactly where that area is. But you got to have the discipline to be able to do it. You got to have the discipline to be able to stick to your plan. That's it's the hardest thing in trading, having discipline to stick to your plan. So I use the risk reward ratio strategy to gauge how much I'm willing to risk on any trade I take. Um, I got to look at the stocks and see, you know, out of its expected range, I got to see like, okay, I think the stock can go from here to here based on previous, support and resistance areas. Out of this range, if I risk on this level, I think I can get this much out of this trade. So the risk reward ratio helps me quantify that thought process. So the purpose for even considering having risk management strategy is to establish your point of exit if you're in a losing trade. It tells you exactly what to do when your emotions and your psychology become jaded due to unfavorable circumstances. I mentioned specifically a losing trade, but it's also on the winning side as well. You know, your emotions can affect you when you're up on your position as well. Greed can get in. FOMO can still set in even though you already have profits. It's crazy sometimes um, what emotions come out of us when we're trading. So this helps protect your account by minimizing your losses and protecting your profits. Risk reward, risk management strategy. So we're going to break this down. The risk reward ratio, or R3 strategy, is based on measuring your risk capital in the potential winning trade. So we're going to go over this slide a few times because it takes a while for everybody to get to how to actually do the math on this. So, first things first, you need to figure out from your own research and thesis what the potential loss or downside to entering the trade is. I'll put it this way: what is the potential downside to entering the trade measured in the dollar amount? So, how much do you think you can lose in dollars? Second question you need to ask yourself is what is the potential gain or upside to entering the trade measured in the dollar amount? So same thing. What's your downside potential loss and what's your potential gain? You got to figure that out from your own research and your homework. So looking at previous support and resistance levels and what type of catalysts are involved with that trade, that can tell you or how much volume is coming in on this particular day that you're looking to trade it. That can tell you exactly, how far this thing can go before it hits, the next level of resistance. And if it doesn't work out, where is the nearest level of support? So looking for what's your potential loss downside is finding that bottom area of support that you can risk off of, and the potential gain upside is finding that area of resistance where you think that the stock will start to, sputter out before eventually reversing. So, and we look to trade it in between those points. We want to make sure, of course, there's enough volatility and range on the stock to be able to identify those points and make a decent profit in between. So once you figure out what these values are for your potential loss or up and down and downside factor, um, you need to factor the downside amount to a common denominator, which is one. So this is how we build the ratio, y'all. So whatever your downside is, like I can potentially lose X amount of dollars. So X amount of dollars, which you can lose on this trade, is equal to one on this risk reward ratio. So this will give you a risk reward ratio of 1 by 1 to the upside, whatever the upside amount is. So the upside, the U, is your potential upside divided by your potential downside. So if your potential, hold on. So this means for every dollar you risk, you have a potential of gaining U dollars. So a trade is considered acceptable when the risk reward is at least 1 to 2. I like 1 to 3. That's why we call this the R3 strategy. So whatever you can, just a quick review, whatever you potentially can lose on this trade, I'm risking losing $100 to make $300. So that's a 1 to 3 risk reward. So here's an example spelled out. ABC stock is trading at $1.45 per share, which is 5 cents under a major breakout level at $1.50. So right now it's at 145 and is getting close to that 150 area. Your research leads you to believe that if ABC stock breaks out over 150, it can go to $3, which is $1.50 of upside, from that 150 area. So you just figured out your upside potential. Your research also tells you that $1 is a supported area that has not been broken, so you can risk off of that area. So if you're buying it at 50 cents and a dollar is the support area, then you have a 50 cents of downside potential if you cut it off at a dollar. Using the risk reward ratio, The downside is 50 cents a share. So we're going to factor that 50 cents a share as one. And the upside is $1.50 a share. So our formula is divide the upside by the downside to get your potential risk reward ratio. In this case, the upside is $1.50 divided by the downside, which is 50 cents, equals 3. So the risk reward on this trade is 1 to 3 because every dollar that you risk losing, you have a potential to make 3 in profits if the trade goes according to your plan. So take a time to look over this slide again. This is how you calculate the risk reward. 50 cents is that the level that you're buying at or you're looking to buy at. So once you buy at 50 cents, if it goes down to a dollar or it goes down under a dollar, you have to cut off the trade automatically. No waiting. And if it goes up to $1.50, or I'm sorry, if it goes up to $3 or near $3, that's where you take those profits automatically without thinking, no hesitation. All right, so I want to give you a visual on how you see or how that last example would play out. Don't mind my chart. I am an artist and I am sensitive about my stuff. Thank you, Miss Badu. Um, so you see this is the $1.50 area right here, this red line. You see the stock, hovering just under $1.50, and you know that somewhere back here in previous chart history, so you can't see it right here on this chart, that it was resistance at that level at $1.50. So if it breaks over that previous resistance point, it can go up to $3 because back here somewhere in the previous chart history, which we can't see right now in this example, $3 was resistance. Pretend it was like some resistance up here, you know, several months back or whatever. So we're risking if it breaks under this support area, which is a dollar, that we'll have to cut off the trade. It's not going to work. So this is our one downside. Look how big this is. And we're risking that if it breaks over this $1.50 area or wherever that's at, somewhere around here, it'll get to this $3 area somewhere over here at this level. So this gain is 3 times as big as this loss would be. And you see is 1R and then it's 1, 2, 3R. So we need to be able to plan and take trades that mirror setups like this, where you can see the potential upside and you can see the potential downside, and the potential upside is at least 3 times as big as the potential downside. That way, if this pattern only works 3 out of 4 times, you know, 3 of the times you're winning, 3R. And one of those times you're losing, 1R. And that's how you grow your account. You got to find setups and you got to be able to trade the setups in a way, in a manner where it can be completely mechanical to, a trading system. This is a trading system. Hope this chart helps you. So, another thing we need to talk about is position sizing. How much shares you should buy whenever you do enter a trade. And there is really no correct answer. Everyone has different risk tolerances. Everyone has different expectations to trading or trading in this particular market that they're trading in. And, everyone has different, trading systems. So the amount you should invest in the trade is 100% solely up to you. But there are a few things you should consider whenever you're, buying stocks or selling stocks. So when you first start trading, don't trade big. Trade very small so you can take a bunch of mistakes without killing your account. If you trade too big too fast, you don't have the experience, the screen time or the market exposure, eventually you're going to make a mistake that you're going to learn from it, but it's going to hurt. You don't you don't want to kill your account. The number one thing we want to do when trading is we want to stay in the game. We don't want to blow up our accounts. You know, that way, I mean, that's why it's okay to cut losses quickly, blow a day trade, and just take the loss because trades are always going to come back. The market's not going anywhere. But if you get too big of a position size and something happens, you can be going somewhere because your account could be getting closed. So definitely start off small so you can get used to the speed of the market. A lot of these movers move very fast. If you're not ready for that fast movement, you know, you'll be like a deer in the headlights, just frozen while, the market moves without you. So once again, I recommend paper trading first. That way you can get a taste of the market. Um, but if you're trading for real, once you graduate from paper trading and you want to start risking your money in the market, then still start off small. But there are some things you should consider. If you have a $2,000 account, I would not go into a trade with more than $1,000 at a time. So I wouldn't use more than 50% of your account if you have a small account. Now, if you hear other people talk about, how a percentage of your account you should use, a lot of them will say like 4 or 5%, but that's not going to be enough for a small account. You know, you need to be able to get enough shares to overcome commissions and fees and be able to risk with decent expectations. So, yeah, when you do not purchase a large enough position, it makes it harder for to trade and make decent profits. This is due to commissions and fees, which may not be applicable now because they do low commissions, but still, you don't want to buy 5 shares of a $5 stock and expect it to go to 40. It's not going that far. You're gonna have to buy, 500 shares or 100 shares in order to get enough money, enough stock. So when it does make a decent move, it compounds the amount of shares that you have. It's all this is compound interest. So we got to have enough items to compound, enough capital to compound. So another example. Let's say you don't want to risk more than $30 on a 3-to-1 potential trade. Let's use a $5 stock as an example. To find this out, you take the number of shares you want to buy. So we used $1,000 of our 2,000. Remember, I said we're going to use 50% of our $2,000 account. So we buy $1,000 of stock, which is 200 shares. You know, $5 times 200 shares is $1,000. So take the $30. You don't want to lose more than $30 on the trade. So how much we can lose? $30 divided by the $1,000, which is how much you invested into the trade. This gives you the percentage that you're actually risking. So $30 divided by $1,000 is 0.03 or 3%. So if we only want to risk $30 or 3%, we will have to take our entry price, which is $5, and times it by 0.03%. That gives us 15 cents. So if the stock drops to 4.85, which is 15 cents lower than $5, we would cut it off for a $30 loss. If we had a 3-to-1 risk reward goal, we would hope that the stock spiked to 545 where we would take profits. So this is how you calculate your position size based on how much you're willing to lose. So you can take this formula, and plug in any number, whatever the stock price is, however many shares you're using, and you can calculate how much you would lose if you took a loss at a certain level. All right, we're going to look at some of the risk levels and risk reward on the chart on or some charts, so we can actually see how this looks whenever we're trading it. So this is a chart of ENDP daily. I shorted this probably about 2 weeks ago. Um, but it was a first red day short. Um, and what I did was I got short and I was basically risking, the high of the day, which was this area right here that my arrow is pointing to. But excuse me, sorry. Um, so yeah, going to the intraday chart, you can see these risk levels a little bit clearer. So I had a bounce short entry off of the previous lows of the day, and I was risking 21 cents to make 60 cents. So I was risking from this I think it was 497 all the way up to 518. I'm sorry. Yeah. To 518. It's hard to see. 497 area to 518, and I thought I could make, 60 cents. So down in the 420 area, 430 area is where I thought I can, get profits, and that's exactly what happened. So with this bounce or with this short, it had its first red day. It came from all the way down. It came from really the 420s, this area where it broke out. That's where the run started. So that was the base of support that I was risking off of, which is this area right here. And if it because I got an entry right here, if it had got up over this 518 area, I would have had to cut it off if it broke over the higher day. So this was my 1R up here. So right here, and this was my 3R down here, down in the low 430s, high 420s. I ended up actually making 70 cents a share because I got all the way in the 420s and ended up covering the very next morning before all this craziness happened. So just look at the daily one more time. I was basically bought it around $5. We just say that to keep the numbers even, risking 525, and I thought I can get basically 50 cents of downside. So from $5 was 50 cents, 450 was 50 cents, about $4. But you know, I had a better entry than that. All right, so here's another one. 3-to-1 risk reward, risking 10 cents to make 30. So whenever this pops up, I forgot to really look back at Mara. Whenever this spikes up near $1.60, this is all this resistance, all in the $1.60 area and higher, going back all the way forever, basically. So we short near $1.60, cover near $1.30 because this top of this candle is a support area. So if it comes back down, it's probably going to stall out right here before it, probably tanks down further. But the move is from $1.60 down to $1.30, which is about 30 cents a share. And if it spikes, over $1.70 is where you cut it off at. That's our risk, $1.70. So not sure if Mara. I gotta check on that actually because this was actually the other day where it was making that spike. So maybe we can pull up a chart and see exactly where Mara is now today and see how that risk level held off. All right. So here's what Mara ended up doing. It's funny that I pulled that one up here. I forgot I actually pulled that. It was on my watch list too. I could have shorted this and made a decent piece of change. So it gapped up. It got over 160, 165. Went all the way up to 175. So if you risk the 170s, the top of this, resistance area, look at the wicks. If you risk that area, get short somewhere in the 170s, and you had tremendous downsides. It's into day two of the downside move. So may get down to the 130s, may not. It depends on what happens news wise, whether dip buyers come back in. But today is having still a down day. So it was at 175 earlier. Yeah, so let me just make sure I'm on the right day. Yeah, okay. So yeah, this is it. This was just yesterday. Spiked all the way up to almost 185. So watch that spike, and once it gives all of this back, cracks on the 175, cracks on the VWAP, which is somewhere around here. That's when you short. Look like it got halted, or just oh no, this is after hours. I'm sorry. And then next morning, popped up for a little bit, continued down. It's under $1.50, so the next area of support is $1.35, $1.20. The only thing is, it's hard to play these because look at the volume. It's so low. You can't really get too big of a position. But 3-to-1 risk reward would have, worked out decently. You know, shorting in the 160s, you know. So we'll have to adjust. So the 160s wasn't got broken. It had a decent push all the way up to actually the 180s. If you look at pre-market, this is in pre-market right here. This is when it opened up. It opened up at 175. So short right at the open, and it just drops. 175 down to 155 is 10%. It's down to 148, so that's another 15%. So there was room to make money on Mara. You just had to be a little bit more patient. So while these, support and resistance areas do play out, you make a plan, short somewhere into this resistance and cover somewhere down here. Sometimes, these stocks can go further than you think. So, but 175 is a key number anyway because it's a quarter level. You got your whole dollar levels, your half dollar levels, and your quarter levels, which always seem to be magnet areas. So I'm not surprised that it got stuffed right at 175, which is right into this resistance. So Mara's pretty cool. I'm glad I thought about that when I did. So hindsight is 2020. Short right into this resistance right from here. It's back down to the 140s, high 140s. You can probably get back or down here, but the meat of the move is done. So this is what I was looking at beforehand. I identified a realistic range. The realistic range is from the 120s to the 170s, 80s. Always kind of minimize my range a little bit. That way, I don't have unrealistic expectations. Base your risk off support and resistance levels. So I think this is a little support area in the 120s. Right now it's trading around 148. You know, definitely can get down to the 120s. Still, you just got to worry about the volume. And the resistance is the resistance. The 160s and 170s for resistance from back when. So you look for bases like this and top wicks, or bases like this and bottom wicks to identify these levels. And when you see those levels on the chart, on the daily chart, and you see it start spiking up towards those levels, you know, especially with a beaten down stock like this stock has come a long way, has a lot of dilution in it. They're bag holders from probably months and years ago when the stock was way up here or trading even higher beforehand. So those people are still stuck in the stock. They don't want to cut losses a lot of times. So any spike up to any of these levels, these people from back here are going to be selling into that just to not make their loss hurt as much. You got to realize that. So you see, unless it has like crazy massive volume like it did right here, it's not going to get through this. This volume is, well, it's okay. It's greater than what was recently happening. It's not that significant. It's not even a million shares. All right, so let's get into the accountability side. You all know this now. This is week 5. You've seen the trade logs I've kept during the course and whatnot, and I encourage you to go ahead and build your logs now. Use the one that I have online on the tools, docs and tools tab. Download that and start playing with it. Put in XYZ stock. See if you buy 100 shares at whatever the price is and sell it at another price. See what the outcome would be. But accountability is so important. Keeps you true to yourself, and it keeps a realistic view on how you're doing as a trader. Keeping a trade log or a log of your trades is the most important thing you can do outside of the markets, outside of the markets. A trade log will help you identify exactly where most of your losses are coming from. You know, whenever you log it, you're gonna know if you're chasing entries or not cutting losses or not taking profits when you should. So whenever you go back and review those logs, if you keep notes in your logs as you should, you should see your trends and your habits show out on paper. Trade log will help you stay accountable to yourself. It's okay to lie to everybody else, but just don't lie to yourself. You know, don't believe that you're doing fine when you're bleeding your account away. And keeping a log will let you know exactly where you stand. So I like a trade log because it's to me it's big time motivation to grow my account and remain consistent. I like to see as little red on my log as possible, and I like to see my profits grow over time to my goals. You should have some goals whenever you have your trading log. Once you get comfortable with trading and you know the some of the patterns and you can make a decent piece of change, you should make some goals. Whether it be consistency goals, you want to go 3 green days in a row without having a loss. Whether it be monetary goals where you want to try to make $500 a week, maybe $100 a day, something like that. So trade logs are used to track the profitability of setups during different market conditions. So Sometimes first green days don't work as well as they do other times. And if you're tracking your stuff as you should at the end of each trade, you will notice that, hey, my first green day profits has been getting lower and lower, and I'm actually taking more losses. But OTC breakouts have been hot. You know, you might want to, the trade log will help you see that so you can adapt your trading real time to what's relevant in the markets for your profitability. Trade logs also help you identify trends in your own trading, like big losses that always seem to come after big gains. So there are other different trader specific stuff, A lot of traders have big losses that always come after big gains because they get overconfident. And if you log in this and you see that you have a nice size win, you know, be conscious of, hey, make sure I'm not getting overconfident, make sure I'm still trading the setups, make sure I'm not being, a gunslinger and being like it's the wild wild west. Make sure we're not just gambling. So most trade logs are done in spreadsheets, but they don't have to be. I showed you before in I believe week one. Sometimes I use a calendar and just track just the profits for that day and the weekly profits. Sometimes I use the software, the portfolio analysis software inside my trading account. And but most of the time I use a spreadsheet. So whenever you are using a spreadsheet, be sure to log relevant pieces of data depending on what you want to, what you're looking to aim for. So your trade log could be as simple or as complex as you want it to be. It all depends on what data you want to track. The log above is the most basic that I would use. I will always have a ticker so you know exactly what you traded. Um, you want to know if you long the stock or shorted the stock. That's very important. Of course, you want to know how many shares and what price you bought it at, or what price you sold it at, your entry price, and what your exit price was. And of course, you want to track your profits and your profit percentage because a lot of times you can make big profits, but your percentage would be small. So it just has you think about other stuff. And you always want a note section. Always take notes on what happened during the trade so you can always go back and review it. Now, this is the simplest log that I would have. Um, I think there's a few other pieces of pertinent information that could be placed on here, but this is fine for right now. Start with something like this and then just keep expanding onto it until you figure out, you know, what you want to track. You want to track, setups. You can put another thing tab here with your setups. So if you're longing first green days, you know, you can look back, hey, in October, were first green days working or were they, not hot? Or were they working, but in your notes you did something to jack up the trade? So that's why it's important to take notes. But this is interesting, if you buy 1,000 shares of $1 stock and you sell it at $1.10, you make $100, which is 10%. If you short 100 shares of a $10 stock and it goes down to $9, you still make that same $100. You still make the same 10% profits. Like how the numbers compute. But it's easier. A lot of times these dollar stocks do spike to become $10 stocks. So rather than focusing on the higher price $10 stock, focus on the 50-cent dollar stock first because you can get more shares and then you can get a higher profits percentage faster with the same type move. So you all have seen this before. This is the trade log that I'm using in the course. Um, it goes much more in depth with the data than that simple log. One of the things that I have here is open date and close date. You know, this tells you you can filter all this stuff, and it tells you if you're doing better at swing trades, holding trades overnight, or if you're doing better at taking quick moves and buying it and selling it intraday. It also helps you when you need to look back. Say, hey, when did I make that crazy 40% blitz F play? Oh yeah, that was back in September. So you can see tracking the date is kind of important. I would almost put the date on this one too, honestly, just so you can go back and when is when. Um, Cumulative profit. This is not really needed. I do this so I can actually graph my trades over time, so I can see like my profit curve. I don't have it listed here, but you'll take the cumulative profit to be able to graph that on a line chart. Don't worry about this. This is something else that I have. Setup. Definitely want to have the setup on here. You want to know what you're trading, and how profitable it is. If you look on these trades, every single one of my OTC major breakout trades have yielded, significant profits and no losses. You know, look at all my continuation plays. My afternoon continuation, my continuation past first green day. I've lost significantly on these, so maybe I should not play the continuation past the first green day. Maybe I should just sell into the morning. And this one I lost, but this first screen day actually worked. In my notes, um, I had I was distracted trading, so I didn't take the profits when I should have. I was away from my phone, which is a big no-no if you have a position. So, and the broker, it's always good to know what broker you're trading what in, especially if you're trading multiple accounts. A lot of times, some people like to get around the pattern day trader the best they can. The pattern day trading rules say you only can place 3 day trades within the rolling 5 calendar days. So a lot of times people get 2 different accounts and they put $1,500 in each account so they can be able to trade 6 times per week and be able to take profits on the same day that you enter the trade so you can be able to capitalize on decent gains. So definitely download this chart and just play with it. See what's possible. Throw some numbers in there. Go on FinViz or Yahoo Finance and say, hey, today is a first green day on this chart. Do your own paper trade. Say, I'm going to buy it here at $5. And then tomorrow, open up FinViz and see where it's at. And then say, I'm selling it here at this point and calculate what the profit would be if you bought X amount of shares. All right. So the last part about accountability is here's another way to be accountable, and it's a good way to be accountable if you do it right. Another way to be accountable in your trading is to post your trades publicly on social media or like a forum or anything that can be viewed in the public's eye. Facebook is all right, it's okay, but I prefer Twitter or Instagram. It's because Facebook, a lot of people ask a lot of questions. You can post on Facebook, but I have the Twitter community is filled with traders. So if you get some following from other traders that are just out there that you meet, um, it can it actually can lead to great discussions on how the trade went, how'd you find it, blah blah blah. So, but posting your trades only works when you're being fully transparent. So If you're gonna post the big time winners, then you need to post the big time losers as well. Don't be like that. Be fully transparent because it's gonna help you in the long run. So when you start trading, I challenge you to post 1 week's worth of trading um onto social media, and then post once you do that and you feel comfortable, or you make it through that, or you do that, a few weeks in a row, then try to post one whole month's worth of trading, and it's going to help you be more accountable. And it works because as humans, we naturally want to impress others. So the idea of on posting profits publicly encourages you to not only take the best trades, but so you don't embarrass yourself. No one wants to be seen as a loser in front of everybody. No one wants to be seen as a failure. So, in order to make sure you don't look stupid out there, it's going to help you clean up your trading a lot. Definitely, I challenge you on trying to do it for a week. Um, some people actually made a YouTube channel where they actually say, "Hey, I'm starting trading today. This is my first day, and every day I'm going to be, posting on what happened to me on YouTube, and like a follow my journey type deal." That's cool as well. Um, it's good because you have a lot of self reflection whenever you do this, and that helps you focus on what you need to focus on in trading. Another thing you can do is you can take screenshots of your charts, edit them with notes of your entries and your exits and whatnot, and what happened on the trade. You can post those to Instagram. I used to do that a lot. Um, and that's also good that you save these charts. You know, 2 3 years from now, if you're trading and you do good and you're still, you know, trading and whatnot, you can always go back and say, "Hey, I started from here. I remember I was taking, $10 gains and they were big winners to me. Now I'm taking $3,000 gains, and I've come so far." So it's good to keep those. And if you ever decide to, pass your knowledge on to someone else, you have plenty of resources already on hand. I also encourage you to record yourself during live trading. So if you record yourself, you'll see exactly what you did, what you were doing while, the stock was happening. You're able to look back at it. A lot of times you make bonehead moves like, dang, why did I do that there? And when, you see in hindsight it's 2020. But, in a moment, it'll help you be able to recognize, setups as they start to set up and play out. You'll be able to review and see exactly what you saw previously in the market that led you to the decision that you made ultimately. And lastly, I encourage you to do trade recap videos. Recap videos that you talk through the trade helps you see your good and bad trading habits. If you're constantly chasing entries, I keep bringing that up because that's my habit. That's my bad trading habit. I gotta curve that as much as possible whenever I'm trading. But it'll show right there in the chart, clear as day. So definitely use the technology that we have at our fingertips today. You can record on your phone now if you're not using a desktop. So you can always take screenshots and post them online, and just stay accountable in your journey. See where you're at. You know, look back at every footstep. So I told you week 5 was going to be short, short and sweet. I want y'all to continuously focus on week 3 and week four's material. Really, week 2, 3, and four's material. They're the bread and butter of everything we're due. Finding the stocks to trade and the actual long and short trading setups. Even if you're not shorting right away, it's good to know the setups because a lot of times, those first red days lead into first green days, and we want to be prepared whenever that first green day happens, so we're not caught off guard and chasing entries. We want to have all of our ducks in a row and wait for the trade to come to us. But see you in the chat room. If you have any questions, definitely post them there. If you at me in the chat room, I'll get the notification quicker. Um, if not, then I'll just be looking in the chat room a few times an hour just to see if anything's updated. But um, see you in the chat and good luck to everybody.